hi everyone, and welcome to this special end of financial year webinar for Intelligent Investor. It's the best buys and biggest risks in 2024. I'm Tom Wilson. I'm one of the investor educators at InvestSMART, which Intelligent Investor is a part of. And we've had a little bit of a mix-up today in terms of the lineup. I know you're probably all queuing up to see John Adders, who unfortunately is a little bit crook. So I've managed to keep the two big heavy hitters, and I'm going to throw questions at them. Now, we know Alan Kohler, obviously, from the financial commentator on ABC News. He's also the regular contributor to the New Daily, but he's also the founder of Eureka Report. And we've also got Nathan Bell, who's the head of research, and he's also the portfolio manager for Intelligent Investor. So we've got them both here. We've got all the questions prepped. Alan has to duck off a little bit early just because of the ABC, of course. They're quite demanding there. But what we're going to try and do is keep a lot more of the Eureka Report type questions up front so we can put them towards Alan. And at the tail end, we'll have a bit more time to focus on the questions just about in investing and value investing. So thanks so much for joining us, Nathan and Alan. How you going?
Good, very good. I'm looking forward to the discussion and the questions.
I'm well, Tom. You may proceed.
Thank you, Gatekeeper. Okay, so what we're going to do first is just remind everyone it's general product advice only. There's not any type of personal financial advice. The other thing too is that part of this newest end of financial year webinar, and hopefully we do one each year going forward, it gives us the opportunity to also let all the new members that are perhaps joining us for the first time, let them know that there's actually an end of financial year special. And there's 3 different types based on the kind of, level that you want to be involved in. The first there is $330 per year. So that's quite a bit of a saving of $264 per year. And that gives you Intelligent Investor for 3 months, but it gives you the weekend brief that Alan looks after for the whole year. And then there's also in the middle, $550 per year, gives you Intelligent Investor and Eureka Report for a year. And then lastly, it's the big guns. You get Intelligent Investor, you get Eureka Report, you get the Australian and the Wall Street Journal. And that's $660 per year. I'll cover those in more detail towards the end, just to give you a bit of a breakdown. But what we might do is I'll throw to Alan now, because a lot of people obviously want to find out more about why you started Eureka Report, when it started, how did it end up coming to be?
Well, it's a bit of a convoluted and interesting story, perhaps. But in 2004, I saw what John Adders did with Intelligent Investor, and he started Intelligent Investor, and there were a few other similar newsletters around at the time that were picking stocks and providing individual investors with, buy-sell recommendations on particular stocks. And so I thought there was a place for somebody who would provide a big picture look, a strategy, investment strategy thing. So because I was likening it to stockbrokers, and stockbrokers in dealing with their clients, in particular institutional investors, gave them buy, sell, hold recommendations on particular stocks, but they also had strategists and economists working for them to provide a big picture advice to their clients. So I thought individual investors should have the same thing. So I spent 12 months trying to get Fairfax to do it with me as a partner, because at the time I was writing columns for The Age and the Sydney Morning Herald. And I thought, well, I'll try to get it done within Fairfax, but they couldn't get their heads around being in partnership with one of their journalists. So I was having lunch one day with John Wiley, and he was pitching some transaction to me, some idea that he wanted me to write about. And I listened politely to that. And at the end of it, he says, "Oh, and what's going on with you?" And I said, "Well, as a matter of fact, I wouldn't mind getting a newsletter up." And anyway, to cut a long story short, John agreed to back it. So I went into partnership with John Wiley and Mark Carnegie, who were then running an investment bank called Carnegie Wiley. And I started Eureka Report in 2005 with some of their money, hired some people, and off we went. but basically the idea was to use my knowledge, but also to get an economist, somebody who was an expert in marketing, someone expert in superannuation, and a few other kind of expertises, and use them as contributors, and provide individual investors with big picture advice and strategic advice on their investments, which I thought would complement what John Addis was doing in Intelligent Investor. And blow me down, here we are in the same company. It's
In the
great.
same boat. Yeah. I mean,
Yeah.
it's definitely something that I've noticed. I know when I try and educate a lot of people starting off investing, I talk about how Intelligent Investor does very much the buy, sell, hold, the research, but you've got the access to the CEOs. You do the Money Cafe, which I was lucky enough to help produce a couple of weeks ago. So much information. You do that with Stephen Mayne and James Thompson, and the banter on that, I guess, has made it one of the most popular podcasts in the business arena.
Yeah, well, it was a while ago that I thought, well, there's a bit of podcasting going on. What can we do as a podcast? And I thought, well, let's see if we can talk in a cafe. So I did that with James Kirby, who was the Australian at the time, and we started off just going down to a cafe and chatting, and it sort of went quite well. And then I parted ways with the Australian, and now do it with James and Stephen, as you say, and it's going really nicely. I love it.
Yeah, it's excellent. It's always good to listen to, and it's a podcast that is free for everyone. So definitely listen to that. You can go to intelligentinvestor.com.au. At the top, there's the the podcast section. But if I wanted to just quickly ask you, Nathan, I know like you've been involved in Intelligent Investor for such a long time, and we've had webinars talking all about the different funds that you manage as well. What's the origin story? I know Alan's touched on it, but even from your perspective with Intelligent Investor.
Yeah, John started the business in 1999, and his idea was that he was tired of brokers, for example, trying to make investing seem far more complicated than it was, and using all types of skills, I guess, and jargon, and therefore making people hand over their money to brokers and other service providers rather than trying to do it themselves. Thinking they would actually be better off if they had the skills and the tools and the knowledge to be able to invest themselves. And that's how Intelligent Investor was born. And it's funny now, but you can go back to when it first started, and you can actually see John sort of riding the tech boom at the time. The idea was right. He wanted to help people and do that cost effectively as well. He would have put the power in people's own hands, but the problem was there was no investing framework to back that up. So it was pretty loose to start with. And what happened was, not too long after that, Greg Hoffman, so my former boss and mentor and friend, he was in there working with John, and he said, look, there's this guy, Warren Buffett, and he does what we call value investing. And if we're going to continue from here, then this needs to be our investing framework. And so that went along for quite a while. And John came in and out of the business over time, and I think everybody just knows that Intelligent Investor is a buy, hold, sell, stock picking newsletter. We're value investors. The name Intelligent Investor is from the book written by Ben Graham back in the 40s or the 30s, and that was Ben Graham was Warren Buffett's original teacher. So a luminary in that sense, and Ben Graham was all about cigar butts, so the really cheap statistical stocks, and part of that sort of parlayed into the early days of Intelligent Investor, where I look back and you essentially the culture was you got rewarded and you got the pats on the back for finding esoteric ideas, no matter how risky they were, but it just showed you how young everybody was at the time. And over time, I took over the research directorship in 2011. And back then we just had two model portfolios and the individual stock research. And if you look at the business now, I left the business between 2015 and 18 and came back. I tried to do a little international service for a year before I left, but it was so difficult at the time. I had 40 Aussie stocks to cover myself, a newsletter to run, two model portfolios, and I tried to do this overseas subscription. I nearly killed myself. And so then I actually went and worked on an international fund for 3 years And one thing I should say, back in 2011 when I took over, was you didn't have to worry about buying cheap, esoteric, risky stocks. Because we were still, that was the time when it was it the BRICS, when all those countries were going broke, and it was still the leftover from the GFC, and Europe was in crisis, the pigs and all those sort of acronyms. And so the biggest and the highest quality businesses were cheap. Like you could buy a CSL at $32, I think was my original recommendation, and Goodman Group traded below $1, and not that we recommended that one, but just you could buy all those great companies, so you didn't have to worry about those esoterics. So I guess I sort of tried to change the culture a bit more to the higher quality stuff because it made sense for our members most of all, but also because it was cheap. Those stocks were cheap. You didn't have to worry about taking big risks. And so then I came back to the business in 2018 and had a few things to fix up, which we've done, thankfully. And again, you look at that original, what you had, the slide you had at the start there about the value on offer, $660. Like I can't remember what the prices were when I joined Intelligent Investor in 2006. But you compare what you get back then to what you get now. Like I remember staying up till 2 a.m. every fortnight on Tuesday night or Wednesday morning, having to edit the hard copy of the newsletter to get mailed out. So some people were reading that information, only 2 or 3 weeks old, and all we had was 2 model portfolios. And if you look at what we've got now, we've got 4 model portfolios, all outperforming, excellent track records. We've got domestic and international service. That deal's got subscriptions to other media in it. It's just chalk and cheese to what we offer today to what we did back then. It's comprehensive. Like there's really nothing else you need. Like there's just no excuses for anyone not outperforming the market now, because at the absolute worst, you can just follow all the trades of the model portfolios, and there's 4 of them to pick from. So whatever your poison is, if you want income, you want growth, you want overseas, or you want something with ESG credentials, it's all there. And then you complement that with all the Eureka stuff and John Addis's, who's back in the business full time these days, writing Outrage Friday, which I think is worth the money on its own. I'm sure some people don't disagree with that. And then, and his more general economics articles, along with all the other guys working under Alan. I mean, you just couldn't get a more comprehensive service, and you couldn't get it any cheaper. I mean, we've really tried to hold the price back over the years, and we have done that very successfully because we want to be there for everybody's journey, whether it's someone who's just starting out, who's read about Warren Buffett, or whether it's someone who's been thrust into the family finances, like maybe they've got divorced, or their partner's died and they used to do all that. So we want to be there for those people. So for what you get for the price, it's incredible. But I still think what we actually have on the website is underused. And I think particularly for new people, the biggest mistake they make is they just go and follow a few small cap buys because our buy list looks pretty small at the time, rather than investing the 1 or 2 years to get to understand how to invest well, and realizing that sometimes the best stocks are actually the ones we've got holds on them because they're the highest quality ones. And okay, you might not get 15% a year from them, but they're actually the right sort of stocks for most people.
Yeah, I mean, absolutely. And we spend a lot of time even in the secondary offers. I know when I talk to you in these webinars, going through all of the value investing basics and trying to educate people about why you see value, quality in different stocks. I might throw a question though, and it's one that I was speaking to you before about, Alan, just about, what's your biggest contrarian view? And this is from Pablo. He's talking about one that you feel a bit stupid saying out loud, perhaps.
Oh, I suppose, I don't really know. I don't have. I got a I suppose the contrarian view that I feel a bit embarrassed about saying out loud in the company at Intelligent Investor is that Bitcoin's going to be around for a long time and forever, and probably is going to keep going. But that's just a personal view, and I don't, it's a bit contrarian perhaps. I try to focus on. I try to focus on the mainstream things for my subscribers, mostly. Occasionally write about Bitcoin, but not that often.
How about you, Nathan? Is there something contrarian that you sort of get a bit embarrassed saying that you've got that stance?
Probably nothing embarrassing other than probably Frontier Digital, but the three areas on the stock market, and this is not just in Australia but around the globe, I'd say that the three areas you want to be targeting if you're really trying to swing for the fences is the small caps have just been largely left for dead. Not all of them, particularly in the technology sector, but just as a general area, small cap and mid cap has drastically underperformed the large cap space. You're seeing a bunch of small cap managers go out of business at the moment just because there's no flows there, and people after 2.5 years of crappy performance have just had enough. And of those, some of those fund managers have actually survived, or other ones that are in good health. They're actually opening up mid cap funds, so that might be like ex top 20 stock funds. And if you look at emerging markets, the valuations in those markets compared to the major Western markets like the US or Australia, they're at pretty much lows that haven't been seen for 2 decades, and in some cases they're at the lowest they've ever been. So if you're a real contrarian and you really want to go digging, they're the three areas.
Excellent. Just to answer some of the questions, this will be recorded and we'll upload it to the YouTube. Definitely ask questions as we go. I'm trying to keep an eye about those questions we're getting and also trying to get through some of the questions that were given to us beforehand. Alan, there's a topic that you're very passionate about. We've got a whole sector on just questions about housing. People asking questions like, are all the factors slowly aligning that will finally see the housing market correct towards the long-term average next year or a bit longer? Do you have much to say on that?
I don't think there'll be a crash in housing. I think that if you look at history, the only things that have caused housing prices to fall has been either interest rates going up a lot, or the Prudential Regulation Authority (APRA) cracking down on investor lending, which is what happened in 2017. So that caused house prices to fall by 8 or 9%. They fell by about the same, 9 or 10% in the GFC. That was obviously to do with the broad economy. When interest rates went up to 17.5% before the 1991 recession, house prices also fell during that recession because of interest rates going up. House prices came down in 2021 and 2022 in particular because interest rates went up. So look, the only reason the house prices will come down is if interest rates go up a lot, or there's some sort of crackdown by APRA. I don't think the latter will happen. I don't think interest rates will go up anymore. So therefore, I don't think house prices will fall. And even if they did fall, it wouldn't be by much. So look, there's no reason to think that there's going to be any big fall in house prices. And I think most likely what will happen from here is that house prices will basically stay where they are, continue to rise perhaps at a slower rate than they have been over the last couple of decades. So we're probably in a period of relatively small increases in house prices because basically houses are overpriced. I mean, if you look at the analogy between residential housing and the stock market, we're in a period of bubble or house prices or prices being too high, and people can't afford them, so they won't go up much anymore. But nor will I think that they go down much.
I'll just stick. There's a question there on the screen from Labosh just saying, how about government regulations? Talking about obviously limiting foreign investment, changes to negative gearing, which it seems like a bit of a political hotcake, and also I guess the immigration where they're trying to make moves on that. Do you think that's likely to happen and have any impact?
Okay, so obviously the Labor Party tried to control negative gearing in 2016 and 2019, and they failed. They didn't win the election, and so I think that's out now. I mean, I think they should control negative gearing and also should decrease the capital gains tax discount from 50% to 25%, as the Labor Party proposed. So I think those things should happen, but I don't think they will. I think both parties are talking about reducing immigration, but I don't think they will. I think that they can't control it. So I think immigration's coming down a bit now. The Labor Party says it'll come down to 235,000 the long term. Last year was 500,000, more than 500,000. So, yes, it's coming down, but it won't come down that much. It won't come down enough to cause a big change in house prices. What are the other things that he's talking about? Maybe
there was also, we're talking about
controls on foreign investment. So foreign investment isn't a big issue with house prices. So yeah, I mean, it isn't something that if they stopped it, which they won't do, or they've already. It is really difficult for foreign parties to buy houses in Australia anyway. I mean, so that's really not going to be a thing. So I think, look, I do think that, and I wrote in the quarterly essay that the governments should be doing things to bring house prices at least down to some extent. There's no real sign that they're going to do it. So look, I mean, I'm not very optimistic about that happening, to be honest.
Sure. The other thing too is, just for the viewers, what we'll do is we'll stick to some of the actual stocks in the last part when we don't have Alan here. We'll try and get the most value out of him we can. But Nathan, I was going to ask, there's a question here as well saying, should we expect a strong Q3-4 rally that sort of aligns or times with the US election cycles? And there was questions that we received before talking about how much does the actual US election affect the Australian stock market, economy, our way of life here.
Yeah, well, I mean, history says that in the lead up, it's good because governments are spending and they spend a lot on advertising, which is a bit of a cyclical area. That's good for stock prices. But I mean, we're long-term investors, so I just don't think this is the sort of stuff that helps you build wealth over time. And this applies to a lot of the questions we've got today. And I can see some of the complaints on there about people just wanting us to get on with stuff and answer some of the nitty-gritty questions. But we've got a lot of new people on here today as well, so we're trying to do the right thing by them. And one of the things I'd say is, like, Intelligent Investor is all about owning great businesses for the long term, and all the other stuff is just noise. It's good and fun to talk about. Like, everyone wants to talk about house prices in Australia and talking about whether interest rates are going up or not. Like, it's great banter and everyone loves it. We're a gambling country. We love a gamble in Australia. At basically any time we can make a special event out of it, and that's sort of our monthly, every quarter debate in the financial markets. But the thing that makes you wealthy over the long term, and if you look at all the people on the Forbes list or the BRW list and the rich list in Australia, they all own great businesses for decades. So if you want to get wealthy, that's what you need to focus on.
That's that's a great example. There's
That's
also
pretty clear. My stuff on housing and interest rates is all just noise.
Well, not if you're buying a home, it's not.
No.
Well, I mean, there's a question here that ties into that that Rob's asked. Basically that equation where housing supply is low, demand is increasing, housing construction isn't profitable. I know, Alan, you were speaking on Money Cafe a couple of weeks ago about a builder friend of yours, I think, saying that it wasn't profitable. Maybe it was Stephen, I can't remember. It just seems like impossible for these guys to try and even build a house and make it profitable, which is what we need.
Look, I think it's very difficult. The building industry is very tough business. Builders have to have a fixed price that they, whether they're renovating or building a house, they quote a fixed price and they get contracted to that price. And then the construction takes a while, 12 months or so. So they're kind of on the hook for whatever happens to their costs during that time, and it's very difficult to make money. The last time I did a renovation, I did a cost plus contract with the builder, and he was just so happy. And I ended up having a fantastic builder and a good relationship, and it worked really well. But in the past, a fixed contract is terrible for builders. The other problem is that a very small proportion of the immigrants coming into Australia are in the construction industry. They don't issue many visas for construction industry people. So we're expanding the workforce, expanding the demand for housing, but the immigration itself is not expanding supply. And at the same time, builders are tending to get old and they're leaving the industry, and not many young people are going into it. So, yeah, I mean, there's a real problem with supply, and the government needs to focus on it, because immigration is going to continue. It has to continue. We can't, as a country, we can't actually fill all the jobs from our own population. We have to have quite a lot of immigration, and we have to make sure that there's enough houses, because otherwise house prices will go up. So the question of whether house prices have to go up, well, I mean, obviously they have to go up in response to rising costs, but apart from that, they don't have to go up. I mean, housing, in my view, shouldn't be seen as a way to build wealth. The way you build wealth is what Nathan said, which is you own great businesses and you subscribe to Intelligent Investor, and they'll tell you which great businesses to buy. But the trouble in Australia is that, and a lot of places around the world, is that everyone thinks the way to build wealth is through a house, by buying a house and borrowing tons of money and sitting back and waiting for it to go up. So your equity in the house expands. But that's that's a really destructive way to build wealth in a country.
I was going to ask you as well, Alan, if you ended up getting approached by Guzman y Gomez to be the ambassador. Did that end up happening?
No. I'm very
No
upset
free
about
burritos?
that. I need free burritos. No, I couldn't do it.
Do you think, I know you're talking about it recently, but and I know Intelligent Investor has written about this with a pretty catchy title, but do you think that Tony has missed, it's just hit $30, do you think he's missed a good deal?
Well, I don't want to repeat what was written in the article personally, but like, you actually think through the maths like this. So at $30, this is a $3 billion business, which doesn't really make a lot of money. Like, it's just frightening, but we're just in this environment where there hasn't been any IPOs, and all of a sudden you get one and everyone thinks, okay, I've seen this being a huge hit in the US, why can't Guzman be the same? But crikey, does the world need any more? Like, I love Guzman. We all love it at Intelligent Investor. But like, how many more Tarkirias does Australia and the US need?
It's true. Alan, what did you think about that?
No, that's true. I mean, look, Collins Foods Group owns Taco Bell and KFC, and they're capitalised at $1 billion, I think. So Guzman y Gomez is 3 times the value of KFC and Taco Bell. No, I don't think so.
And what about, Jane just asking here about the impact of AI on markets, and will investing be changed by the AI algorithms? But I feel like this is something that's been going on for nearly a decade, hasn't it, with all of this computerized trading, black box trading. Do you have much about this, Alan, talking about AI? I know you spoke about NVIDIA a while ago as well.
Well, yeah, as you say, we've had computerized trading for a long time now, and algorithms have been doing that, and we've kind of settled into, I think, a norm of that. It's kind of a part of life in the stock markets. I think everyone's used to it now, but artificial intelligence, as the NVIDIA's behind, is something else entirely. So I think I think the AI, the artificial intelligence that NVIDIA's doing with its GPU chips, is going to be in everything. I mean, it's going to change life. It's going to change the world in ways that we can't imagine at this point. I mean, they're only still training these AIs. I mean, they're just we're just at the beginning, of stuff that is unimaginable in my view. I mean, so yeah, I do think that AI will change stock markets and change the way computerized trading operates and the way that we operate in the stock market. But I've got no idea how. I don't really know. Maybe Nathan's got it worked out. I don't know, but I certainly don't. Have you, Nathan?
I have not, but like, even before we get to AI, like, just look at the impact that ETFs alone are having at the moment on the markets. Like, you've just got these incredible valuations for the top 20 stocks in Australia or the top 7 stocks in the US. And I think I'm right in saying this, that ETFs, I think it was like, I don't know, 4 or 5 months ago, are actually a bigger part of the market than active fund managers now. So we've been a dying species for a while. And part of the problem with being a value investor is sometimes you have to sit there for a very long time waiting for your stocks to come right. And if you've got all these algorithms chasing a certain thing, which basically is momentum in the earnings, that's essentially what they're chasing. So as long as you've got those momentum in your earnings, then your share price goes up. Now, that may have nothing to do with the actual long-term value of the business. And there are plenty of stocks that aren't making much money and don't look like they're going to make much money trading it, for billions of dollars, or in the US, they're like tens of billions of dollars. And that's what we're competing against as active managers. And you're trying to do the right thing and buy the value stocks and the appropriately priced stuff, but you get in these long, it's been a long time now where growth stocks have been essentially a winner takes all for the market. And if you haven't owned them, it's been almost impossible to outperform. So even just ETFs, which has got nothing on, what AI might come up with, but that really programmatic, not really thinking too much about the stocks, or if at all, not thinking about value. I mean, these are trends that we've had to deal with for a long time, and they're only getting stronger.
I had a I had a graph on the news last night of the PE ratio, the valuation PE ratios of the top 10 stocks in the US and the other 490. So the other 490 are on an average PE of 18 times, and the top 10 stocks are on a PE of 30 times. And that 18 times for the rest of the market is basically the same as it's been for 25 years. It hasn't really moved. And the PE of the top 10 stocks has tripled from 10 to 30 times in the past couple of years. So it's so what's going on? This kind of drift towards momentum investing, which is as opposed to value investing, is kind of distorting the whole market now to the point where it's becoming very difficult to apply any kind of rational thinking to what's going on, because anyone who didn't own NVIDIA, really, not just the top 10 or top 7, but anyone who hasn't owned NVIDIA has underperformed. It's gone up 40% in a month. Crikey.
I think the real mistake
Well, I
that
think
people can make with these situations is that, one, they're the patsy, the last person to get on board, and they just pay these extreme prices when essentially the odds are against them. And interestingly, I don't actually think those top 7 stocks are crazily priced. If you have a look at the return on equity for those businesses, we've just never seen businesses like this before. They're absolutely incredible, and they control our lives. And anytime we've had something approaching that, which might be, say, the oil stocks, when Rockefeller owned them, when they got split up, he continued owning all of them anyway. But the government come in and oppressed them, or made them change or split the companies up or whatever. And there's just government really is piecemeal tried to do that, so it's not happening. So these businesses absolutely control our lives. And you look at Apple, and its earbuds business is bigger than most of the stocks on the ASX. Like it's just its earbuds business. So it's quite frightening. But there is value in those other 493 stocks, but value managers who might have to sit there for 5 years and own them to get the value, investors just aren't that patient anymore. So why would they want to do that when they can just buy an ETF? Like if you just bought, I wish I had done this. If you bought the NASDAQ at the bottom of the GFC, I think you've made 16 times your money, just by buying an index. I wish I was smarter back then.
And it looks like, questions like even Glenn there talking about sitting on his hands after the GFC until the pandemic. But Alan, I know you've a bit time limited. If you need to shoot off, it's not a problem. We thank you so much for coming and answering all these questions so far.
Oh, it's great. No worries. Let's do it again.
Excellent. We'll do it again. We've got so many questions, and it looks like there's very different themes too. So you can always listen to Money Cafe and even submit questions. And Alan and his guest that week, they do go through them and look at all of them and choose the best ones. So thanks so much, Alan, and we'll catch you next time.
Thanks, Tom. See you, Nathan.
See you, mate.
And goodbye, everyone.
So I guess we've come down at least to Nathan and I now, and there's been a lot of questions on here about stocks, and probably questions that are very much Nathan's right up his alley. So don't hold back. I guess you probably get asked this every single time, Nathan, but is there a stock that you are feeling a little bit comfortable about, excited about, something that you've got your eye on?
Like nothing really new. It's like the things that like I'm most interested in personally are just smaller businesses that can become big businesses. And because there's been such a dearth of IPOs and corporate activity has been pretty slow for a while, there really hasn't been anything new that's come along. But what I'd say for people who haven't seen the website today is that we just put a article up with the 5 top blue chip buys. So it's actually like the biggest stocks have been so expensive for so long, and unbelievably, like some of the bank stocks up until this recent rally, really haven't gone anywhere for 20 years or more for some of them. And I was looking at Woolworths after the price come back recently, and we nibbled at it in the portfolios. And when I started at Intelligent Investor in 2006, the share price I think was like $28 or $29, and now it's back to $30. So I've been an Intelligent Investor, aside from those 3 years, for 18 years. And this stock that I used to cover, one of the highest quality stocks on the market, inflation adjusted, is actually below the price I was covering it back then. So it just shows you that sometimes old ideas become good ideas if you wait long enough, but also the dangers of overpaying for stocks. And if you had a portfolio back in 2006 of Telstra, Woolies, the banks, and whatever, like you actually haven't done very well over a long period of time. So, that's really why we exist. We're trying to find the better stocks than that. Now, I know a lot of retirees, for example, just want to get their dividends and that's all they care about, and that's absolutely fine. But we're really trying to beat the index handsomely, and you need to own those REA groups, which I mucked up during the GC, not upgrading that, but the Wise Techs and the Zeros, like you really need to try and find them early, and that's what really I spend my days doing. Other than all the other basic stuff I do, but that's what excites me, trying to find those next big stocks. Yeah, I'd just say also,
Yeah, and we get a few
yeah,
questions.
sorry,
Sorry, go
Tom.
for you.
People have probably heard us banging and me on the fund webinars for 5 years now about Ordinate, and essentially as far as you can on a small cap stock that doesn't make a profit. We were banging the drum, and I was saying it's one of our key stocks, and then as little as 6 months ago, I was writing, look, the stock price has taken off. It's going to take a while for the earnings to grow into this stock price, and then it just doubled again. Like it got up to $24, and so it's amazing when these smaller stocks just take the people's the sort of momentum in the market, but people get excited about them. They finally realize what they are, and then you get you have to wait for like 5-6 years to get that return, but you get these huge returns in such a short amount of time, and that's really what I think value investing is. It's finding those stocks early, or buying the out of favor stock, and then you've got to sit there and wait patiently for the returns to come. But usually you get all that return in a very small period, and so Ordinate got upgraded to sort of caught the market's fancy. It's a technology stock and got through its GFC problems, and everyone realized what it was. Then it gets included in the index, and they all come rush in and start buying it and bid it up, and then we've been selling it to a much smaller position because of the valuation. And then RPM Global, which I know Gaurav's got a sell price on it of $3 at the moment, but I expect he's going to upgrade that or increase it soon when he sees the result. But I think that's potentially a $4 to $5 stock, which is why it's one of the largest, or the largest position in our funds or in the model portfolios. And that's halfway through that process now. So it's just starting to get bought by the small cap managers. It's about a $600 million market cap now. And once you get past that $300 or $400 million market cap, that's when the small cap active managers get interested. And then once you get 600, 700, 800, that's when the indexes start buying. So RPM Global's halfway through that process, and poor old Frontier, that's just been left for dead. But that's the process that I hope it's going to follow. It's just less than $200 million market cap now. It's too small. It needs, you actually saw it coming early this year, had a good result at the end of last year. And then everyone thought interest rates were going to go down and inflation was under control. And then you really saw the smaller microcaps started to rally really hard. And Frontier doubled, very quickly. But the problem was then we got I think it was March print on inflation that was a bit higher and sticky, which shouldn't be a surprise to anyone because the government's spending so much money. We've got a economy that's in absolute overdrive. We're slamming 600,000 new people in here a year, all want to live in essentially one area. Like it's just too much for our economy to handle. So it's no wonder prices are going up. But what else do you think is going to happen? So the RBA, when we talk about central bank independence, well, there's not really any, because they've been too scared to say that it's the fiscal spending is actually, and the immigration is what's driving up the prices. It's just too much happening in the economy at once. And then you've got, everyone's got a job, so there's no unemployment, so no major unemployment, so no wonder house prices are fine. And when you've got really expensive real estate like you have in Australia, like, it just increases the cost of everything. And that's why restaurants are going out of business. They've got huge rents. We don't cheat people on labour in Australia. We pay good wages. We have a very high wage country. So when you've got all these factors in, like, it's actually, everything's a lot more understandable. But anyway, back to Frontier, trying to find those small stocks. I think what I really hope that happens with the economy over the next 12 months, and obviously we don't know what's going to happen, but is I really hope inflation does sort of come under control a little bit as immigration falls a little bit, or at least the growth levels fall a bit. And if the economy can just relax a little bit, then I think you'll see what's happening in emerging markets is that the inflation's starting to come down now, and then interest rates in the Western world are already starting to come down. Canada's already started. Hopefully the government spending falls a little bit. I don't know whether it will in the US after the election. And if we get that, then you'll have what we had in November, December, January, February, which was people started to feel that interest rates were going down and there was less pressure. And then all of a sudden, a lot more interest in stocks outside the top 20. And that's when, as long as Frontier is growing right and doing all the right things, then, I think that could triple very quickly.
There's heaps of excellent questions coming through, and I'm going through them and looking at them. I think a little bit of your connection, Nathan, might be skipping a little bit. I'm not sure if it's the internet connection or not. There'll definitely be an uploaded version of this later on, but I think all the main points Nathan is coming through. There's a question here which is really interesting because it ties into so many different things. Glenn's asking, at what point would ASX D listings effectively force active managers like yourself and your team to have to start looking offshore?
Yeah, well, we've already done that. We launched the Select Value Fund about 18 months ago. And that was really just, I've been doing international investing since 2007. So that was pretty natural, and Nick's been a big help on that. But for anyone who's invested in the ethical fund, we've actually made this decision in the last month and sent out a letter to investors. And the number of stocks, high quality stocks that pass the ESG filter in Australia is so small. And it was just like, and then you get companies like Altium just getting taken over and taken off the market. And I expect the same thing will happen with RPM Global soon enough. And it was just getting so difficult. And I said, look, either you've got to accept lower returns, which obviously no one's going to invest in the fund if we can't outperform, or we've got to, or you got to take more risk. And the one thing I don't think most people understand about the stock market is the more risk you take, the worse your returns are going to be. I think people think the more risk you take, the more returns. It doesn't work like that. And so the obvious option was just to have, we didn't want to turn it into an international fund. We just needed half a dozen new names to fill up the tail end of the portfolio, so we were still adequately diversified. So come 1 July, so 2 weeks, we're able to invest up to 30% of the ethical fund in international stocks. So perfect question. That is absolutely spot on.
Excellent. There's also, I guess, a question that ties into how our internet here in Australia is subpar the rest of the world. And it's a question from, let's have a look, just had it here from Rob, because we basically added Aussie Broadband, didn't we, to the ETFs recently? And Rob's just asking, what kind of runway do you see if you cover that one? I'm not sure if it's you or
Yeah,
the
no,
other
we
guys.
definitely do. So Aussie Broadband's a core holding in the portfolios, and actually looks very cheap on the numbers. I think Gaurav just wants to see the next result before sort of, I think he was a little bit shaken about some of the weaker results recently in the acquisition that didn't go through. But what we've seen in history in Australia is that in the telco space, we've invested, I think this is our third one now. These minnows, there's actually a lot of activity and a lot of assets that they can acquire, and it actually makes sense to roll them up together. And eventually they get big enough, and then they get taken over by the big companies. So that's really what you expect from these minnows. So Unity was a big one for us in 21, and I think maybe I'm just thinking of Aussie Broadband when it got to over $5. and it had a takeover premium in the share price then. So I sold most of it, if not all of it, but then bought it back or increased it after that. But we really like the guys who run that business. There's plenty of room for growth there, getting more into commercial rather than just residential. So we like the business, but it is a small cap company, so just make sure it's got the proper amount in your portfolio. I think that's actually
I just
just generally.
put up some of these.
Sorry, Tom. I was just going to say, I think just generally speaking, I think as interest rates, at least when people think we're past peak interest rates and aren't worried so much about inflation and higher interest rates, which I don't know whether it's going to be 2 months, 6 months, 12 months, but I think you're going to see a lot of takeovers at that point. All these small caps just aren't going to be there anymore. RPM Global, Aussie Broadband, that would be two that I would think be high on shopping lists.
There were some other questions here, just even talking about, I guess, like the data center stocks, like Infratil as well. I think, was it Infratil before?
Yeah.
Getting a question about, it had a SPP, didn't it?
Yeah, we've got Gora's publishing an article on Infratil, will be up first thing tomorrow morning.
Yep. And that's the thing I've noticed, and I often talk to people when we're teaching the investment education course, that they get the 4 weeks complimentary access with Intelligent Investor, and it's a great place to learn, because when something happens, you and your team, that you're fairly quick once you've digested all the information, because you get it at the same time as the rest of the market does. Like, you don't get it ahead of anyone, but you are able to analyze it all, put it into an understandable format, what it actually means in terms of if it affects any recommendations, for instance, and then you publish it on the website. So it must be very high pressure sometimes keeping up with those deadlines, but that's what you do get when you subscribe to the Intelligent Investor. There was another question here talking about lithium, which is obviously it's obviously a big area that we've covered as well in the past. Do you have much updates in terms of this space, like Selena's asking?
Yeah, so our two big recommendations in that space are Mineral Resources and Pilbara. They're quite different businesses though, because Pilbara is the pure play. So in that sense, it's more risky because it's all about the lithium price. But the really smart thing that company has done is they've got a multi-billion-dollar war chest sitting of cash sitting in the bank. So no matter how bad things get, they've got the financial wherewithal to get through it. And they've done a really good job with their investments over time. So pretty impressed with management, even though if you look back through its checkered history, they did a lot of things before they finally hit upon something that worked. The difference between lithium, though, and a lot of other commodities is lithium's fairly easy to get a hold of. But what we are actually seeing at the moment is we are starting to see cutbacks. And that's really what you want to see as a sort of bottoming in a commodity cycle, is that it's like uranium 5 years ago when Kazakhstan started cutting its production, and Cameco, which was it's the biggest company in the uranium sector, the safest one, it started cutting production. And here we are 5 years later, and stock prices in that sector have gone up anywhere from 6 to 15 times. So you had to sit there and wait for a while, but you saw what you wanted to see as in terms of a long-term investment. And we're starting to see that with lithium now, that they're starting to see production be cut. There's a lot of articles on websites at the moment about EV demand not being as strong as what it was. There's a very real risk in the technology that it might actually go to lithium, might have to give up some to sodium-ion batteries. So that is a risk as well. So that's why I can't remember whether Pilbara is a speculative buy or a regular buy, but you need to be careful about your portfolio limits there. But MinRes, to me, is essentially you're getting lithium for free. So if lithium becomes a good business in the future and prices go back up, then that's not in the share price at the moment. Basically, MinRes's share price at the moment really just factors in its mining services business and not much else. So that's why we like that. To me, that's perfect value investing. Insider owner with his wealth on the line, business with high returns on capital, so many growth options. That's not funny. The balance sheet's a bit stretched, but it's not really, because it could sell assets if it really wanted to. It has done that with the half of the Onslow Road at the moment. And it's got a share price that people are just so focused on the iron ore price at the moment and lithium price. They're just not looking at the mining services business, which is essentially an iron ore crushing business. and it's got 50 to 70 year licenses, like basically got end of mine licenses to crush the ore. And so, regardless of the iron ore price, that ore still needs to be crushed. So, you're getting a lot for free with that business. I own it personally. I think everyone who follows us knows that Gaurav likes it. And it's one of our biggest holdings across the portfolios, because we think the downside's really low, and you're getting a free option on all the the iron ore business and the lithium at the current price.
Yeah, I remember he spoke about the CEO of MinRes, the last webinar that we did together. I think he probably spent most of the time talking about how good he is.
Look,
Um,
look, this is a
the
business. It's really complicated. It's got 4 different divisions.
mm,
There's a lot going on. It's in the papers all the time. But what Chris Ellison's done with that business has been amazing. And that's why I really think of my job is not investing other people's money, but getting their money and giving it to someone else to manage. That's the CEO or the founders of
mm.
these businesses, and that's why I'm always harping on about founders running the business, because there's just nothing like it. It doesn't mean we're not going to own CSL or these other great businesses, but when you find those entrepreneurial guys that just love their businesses and can run them for 30 or 40 years, like, just the returns can be astounding. Like, they can be life changing.
There's probably even moving a bit away from individual stocks and probably even going to a bit more of like the management role that you've got. I'm not sure if you can answer this, but we can also publish it later. But do we tend to announce the distributions from the 4 funds? Is it usually in July sometime or a bit earlier?
I actually can't remember, mate, to be honest, but it's certainly at the latest in July. The one thing I'd say is there won't be
Yeah,
huge capital gains in any of these ones like there was a couple of years ago. So it should just really reflect the actual underlying distributions coming out of the businesses.
yep. Yeah, there's definitely heaps of more good questions coming through. I'm just trying to pick some that
Look, I
help keep.
just while you haven't looked there, Tom, to anyone listening today, if we don't get to your question, just remember we do these webinars every 13 weeks as the part of the secondary offer for the funds. So even if you're not interested in investing in the funds, if you've got questions, by all means put them on those webinars as well.
Yeah, absolutely. And the other thing too is, and we tell a lot of subscribers and clients, is that when you write about these companies, there's actually the comment section, which I've seen all of you look at and also reply to. So that's also another way to contact and talk about the actual companies at play as well. I'm
I can
just
see one there on
seeing.
PEX Group. So
Yes.
PEX Group's always been one that I've just found too hard. It's essentially got a monopoly on conveyancing and a bunch of other real estate administration pieces, and it's now going overseas to try and do the same thing. But there is actually a current push by a bunch of people to break that monopoly in Australia. And so it's always traded on a really high valuation and with question marks over the monopoly, which would really smash the profits of the business. And now it's going overseas. So I've just always found it too hard. It's been always been expensive. And when I see companies that haven't actually completely dominated and secured their home turf, then go overseas, to me that feels like they're trying to cover up one big problem by doing something risky. So Pexus, I just find too hard.
And yeah, I mean, this is a good question too from Stephen, just talking about living in uncertain times. I did a webinar yesterday with our chairman of InvestSMART, Paul Clitheroe, and Effie Zahos, who's the chief content officer. And we went through a lot of different sectors that I guess a lot of us are even feeling the pinch as well on a micro level. But what about the flip side? Is there sectors where you feel a bit more favorable, a bit more comfortable with?
Look, the article that we published today with the 5 blue chip buys, I mean, that's perfect for, I think, anyone thinking this way. I know it's the contrarian in me, and I'm certainly not telling everyone to go and buy Frontier, but um, when you get things that like we're seeing trends in the market at the moment that are 20 years in the making. If you talk about how strong the US dollar has been, how far US stocks have gone up and how favorable they are now, like this is what the stock market does best, is it takes ideas and pushes them to the absolute extremes. And so as a value investor, I'm naturally attracted to, okay, well, if the extreme is everyone's invested in US stocks and technology stocks and the US dollar, well, what's been left behind and what's now trading at 2-decade lows? And to me, again, I'm just using Frontier as an example, but Frontier ticks every box that nobody wants right now. It's in emerging markets. The last quarterly was okay, but it wasn't anything to get excited about. It's investing hard in the business, so it's not showing big net profit growth. Like the markets love simple stories, and Frontier is anything but simple just at the moment. And it's in areas that are mostly affected by inflation. So of course we've seen what's happened in Pakistan. The currency's been cut in half. So I understand why people don't like it, but for those people who want to dig harder and look for, what I'm trying to say is that sometimes you find safety in what's hated because the price is so low, it's compensating. Now, only time will tell for Frontier, but I don't personally, I don't want to go into China. I just think that's a whole different kettle of fish. But as a value investor, these trends have gone so one way now for so long. I actually think once this inflation's under control, and once at least the spectre of higher interest rates has gone, so at least people think they're not going up, and the next move is probably down. I think people who are in those hated areas are going to do really well. I just don't know how far away that is.
And there's another question there, I think, from Stephen, and I guess it comes a bit more to that idea where I know that you've always been talking about, you want to see the founders involved. Skin in the game is a term you often use. Bad managers destroy good businesses. Do you try and target the good businesses, or do you actually try and look to avoid the bad managers? What way do you go about it?
Yeah, no, it's both. There's I know there's one fund manager in the US that calls it the three-legged stool. So that's the quality of the business, the quality of management, and the valuation. They're essentially the three things that every active manager is basically focused on. Every fundamental every fundamental investor. So it's both of those. But I remember one person once said, you've got to be careful about paying twice for a good manager. Because the business is already going so well. Like, are you paying a big premium because the CEO is good, and then eventually they leave, and therefore you've overpaid for a stock? But we want to be in quality stocks. It's just really hard to buy them cheap, and that's why I always recommend to anyone who's a member of Intelligent Investor is always look at the holds. Like those holds, the great companies, the CSLs, and the WiseTechs, which we've missed, but they should be the rump of your portfolio. And for most people, that should be all of their portfolio. And then for the others who actually like to really go for, swing for the fences, then maybe you look at the Aussie Broadbands and MA Financials and, RPM Globals and those sort of things, because we really try to pick the eyes out of the small cap market. Like we can't own many in the funds anyway because of the very, very strict liquidity limits because they're ASX listed funds, which then flows into the model portfolios. But there aren't actually that many great small cap companies that come through. So that's why we don't have a lot of them. Like, the RPM Global, Audinate, MA Financial. The only reason I invested in Frontier was because I thought this could go up tenfold. Now it hasn't done that. And, if you followed the company, you know why. But, I don't think it's going to go up tenfold from here now that Pakistan's worth half what it was, but it could still go up 5 to tenfold if everything works out. So without that big payoff, I wouldn't be mucking around in emerging markets. But the number one reason I was attracted to that business in the first place was because the online property portal businesses like REA Group, these are, other than perhaps Visa and MasterCard, the single best, highest margin businesses that have ever been created by mankind. Like that's what got me there. Like, it's just how big these businesses can grow and how fast they can grow, which is why when these businesses are mature, and if you look at Rightmove in the UK or REA Group in Australia, they trade for 15 to 25 times revenue. Like these are absolutely incredible businesses, huge free cash flow, essentially a monopoly, can't compete against them. And, and obviously the risks were different for Frontier, but Frontier trades at less than 2 times revenue at the moment. So it's just, if a little bit of confidence comes back to the business, and the business can actually get those margins up to 30 or 40%, that's when we'll see hopefully a stock worth, $2 or more. But the point is, it's the quality of the business and the management is I'd say more important than valuation. Valuation is third most important. Those first two things are most important. And I'd say quality of the business is the most important. What does Warren Buffett say? Says, a good manager who takes on a bad business, it's always the business that maintains its reputation.
That's a good point. Well, on that note as well, the ASX code for Frontier is FDV, their GB, but we're going to have to wrap it up because we've reached the end. We've got so many really good questions and would love to get to them all, but I'll put them all together and I'll give them to the Intelligent Investor team to see if they can try and weave them through, or whether another webinar that focuses on specific things might be helpful. This webinar was really about the end of financial year for Intelligent Investor, showcasing obviously Alan and his team and Nathan Bell as well. There's obviously the subscription pricing there, particularly for all the new members. We've had such a really large interest from brand new members, and we're always welcome to get them on board. I'll quickly run through just so as you're aware. And if you've got any problems with this pricing in terms of you're a member and you've just renewed, definitely give our team a call or email and we'll try and help you wherever we can. There's the first deal, of course, $330 per year. That's been a saving of $264, and that's Intelligent Investor for 3 months. Weekend Brief, Alan's Weekend Brief for a whole year. There's a QR code there as well. It puts the code directly in for you. There's also the $550 per year, save $693. Intelligent Investor, Eureka Report for a year. Lastly, the whole package, $660 per year. Intelligent Investor, Eureka Report, mouth's getting sore from saying all this, but Australian and Wall Street Journal. And what I'll get Nathan to do as well is, there's a lot of questions coming through about, the best buys, biggest risks in 2024. That might even be worthy of its own separate, concentration. Do you think, Nathan, because we didn't get a chance to run through them right during this webinar? We always run out of time trying to cover everyone's questions.
Yeah, I think people are sort of asking what are the best buys and what are the actual risks, and I apologise for the sound problems that some people are having, but the biggest risks are, well, if we have covered them indirectly, is that overpaying for the most popular stocks at the moment. That's why we've got the top 5 best blue chip buys out. So go and read those. Valuation is what matters. I think I don't think the biggest risks are inflation or interest rates or those type of things, but if you're really looking for something to get frightened about, go and have a look at the US office property market and where those huge loans are sitting on the banks at the moment. And again, the best buys are on our website, and I've talked about a bunch of them. But don't forget, you can always go and look at the model portfolios and see what we own, because we don't own those businesses. And we've talked about MinRes, we've talked about RPM Global, talked about Woolies. So we've talked about a lot of stocks, but go on to the website and look it up, all the detail. It's very easy. The top 5 stocks articles couldn't be any easier to read if you tried. Go to the buy list. And again, just look at the hold sometimes, because sometimes do your research, the holds end up being our best recommendations, but we're just a little bit too conservative sometimes, waiting for the right buy price. And if you do that, there's actually quite a lot of opportunity out there at the moment.
Well, yeah, thanks so much, Nathan, for giving us all this information. And thanks to Alan, of course, who had to leave just a little bit early. Really appreciate all the feedback, whether it's talk about this, talk about that. We appreciate it. It just shows how active and committed that you are as viewers, as subscribers. And that's something I think that makes the community at Intelligent Investor quite special, because you're all part of something. Thank you very much for joining. Nathan, thanks so much again, and I'll see you next time.
Thanks, Tom.